Hi there, and welcome back to the channel. Okay, well, a quick one today. I just want to speak about something that I don't know a lot of investors probably fall prey to. Um, so, um, should investing be boring or should it be exciting? It's like, oh, the next meme stock. Oh, this stock has gone up. Everybody's buying this stock. Let's get into it because it must be amazing because it's going up. Sometimes the stock price does go up because the company is amazing. But the stock price and the company's price is not always matched. In other words, a company can be being stagnant and the stock price could be going up or could be going down. If the stock price is going up, people are buying in. Sometimes people start a rumor and people, what they call FOMO in, fear of missing out. They see the stock rising and see everyone making money on the stock. They don't actually look at what the company is or what the company does or if it's profitable or anything like that. Often, and you find all these market bubbles like that. The tech bubble in 2000 was definitely like that, 1999, because what happened, a lot of internet companies listed with no profits. So people were like anything with .com in it, people were just piling into. Obviously, in between them was obviously some good companies, for example, like Amazon, etc. So, in other words, if you'd have got into Amazon at that time, you'd be doing very well. But people FOMO into stocks. They buy stocks and then as the price is going up, because the people start a rumor and they know that the company is not something that should be going up like that. So they get people to buy in, and then they sell out at the top, and they make the profit, and then the guys holding the stock, the price just drops, and yeah, at the end they either sell out at a loss or they don't know what to do because they don't know what the company does, what the company's profits and future profits are going to be like. Now, so FOMO is not a good thing. Um, so what I encourage is to be boring, and it's strange because usually boring is not what people want. They want instant. They want fast food, instant. They want everything put together right now. They don't want to wait 1 minute. They just want everything right now. They that's why the fast food places do so well, because people just want food. They don't want to wait for something like a nice steak to be cooked, matured. They actually mature the steak, marinate it, and then they cook it. They take the time. They don't want that. They want something right now. And that, unfortunately, the FOMO with FOMO and buying shares like that, meme stocks, unfortunately, the only person who makes money is the broker, because they make money on the buys and the sells, so they work money on each trade, so they make money, but you don't make money. So what you must do is buy boring companies. A lot of the major big investors like Warren Buffett, Peter Lynch, says there's a few more as well that say rather buy boring companies. The boring and the like jobs that they would hate to do themselves. If something is so like monotonous, and that's actually the company that they look for, because they know the profits will rise every year. If they pay a dividend, the dividends will rise every year. So what I say to you is look for stocks. Look, I buy some growth stocks and I buy dividend stocks. You obviously both of them you want to see grow over time. But for example, your dividend stocks. If you buy stocks today or you bought stocks recently, what I say to you is buy and hold them. Obviously, if the story of the company changes, then you might look at exiting or reducing your position. But if the company's story is still intact, then don't even look at the share price. Let the share price go up over time, and then reinvest your dividends. And don't worry too much about after maybe, let's say, 10 years or whatever period you feel comfortable doing. I would say buy and hold for at least 10 years to 20 years. And then after maybe 10 years, then look at it, look at the share price, look at the dividends that you received. If you're receiving good dividends over that time and reinvesting it, then you can see, okay, the dividend's going up every year. Obviously, before you buy, you look at the payout ratio, you look at different things to see if this dividend is sustainable, if the dividend growth is sustainable. And if a company's cash flow is used up by paying out dividends, then obviously you know that they haven't got room to increase it, and they might even cut the dividend. So you buy your company, you research it before you buy. You buy a company and then you hold it. Give it time. Give it time. Compounding takes time. Give it, say, at least 10 years, 20 years. Then you look at it and you say, okay, this is giving me X amount per year, and it's going up every year. The share price has also gone up. So my total return on this is like X amount, and then evaluate it. If it's doing well, hold it. Buy more if you think. So that's the way to do it. And a lot of the big investors say the same thing. You should be able to tell, explain it as if you explain to a 5-year-old child what the company does. In other words, you can't just say, okay, why did you buy this share? Oh, I bought it because the sucker's going up. That's a quote of Peter Lynch, So you don't just buy it because it goes up, because then you don't know when to sell it, or so always know what you own, know what companies you own, know what they do, and follow look at your dividend. Some shares pay a high dividend. Some shares pay a high dividend. For example, they pay like a 6 or 8% yield or whatever. If you can get a share with a 6% yield that's growing at 2-3%, then that's pretty good. Or if you get a share that's growing at, say, 2-3% with a 10% or 20% growth, dividend growth, then that's perfect. And you hold that for years, and you'll see the growth, and obviously you're compounding especially if you reinvest your dividends, a drip, and you buy more shares as you go. You'll see in 20 years' time it'll be creating more and more income for you, and that's something I've been looking at recently. Try to increase the income factory. Like I say, I also want to have growth stocks, because I see there's obviously unlimited growth in some of the stocks. So obviously you want to see huge returns on them in a few years' time. But yeah, also just holding them and wait until the market actually realizes what's going on. And in 20 years' time, some of these shares can maybe even 10x, 100x in 10, 20 years' time. So, but your dividend stocks are put money in your pocket. Now, a lot of people say that's the actual definition of an asset, something that puts money in your pocket, which is your dividend stocks. So every month they can pay you out, you can reinvest it, and then when you get to retirement, if you've built up enough of a portfolio, you can actually use some of your dividends to pay some of your bills, or if you're lucky enough to pay all of your bills. So that's it. Be boring and make some money, and don't look at your portfolio every 5 minutes. Unfortunately, I am guilty of doing that. I really am, and I'm trying to do it a lot less. I think yesterday I only looked like twice or something, but unless obviously I want to obviously buy, then I might look at it a bit often, a bit more regularly to see how the price is doing, and then But yeah, don't try and time the market though. The market has dropped a little bit. So it's if you dollar cost averaging, if you're buying every month, you keep buying, and you see your over time this maybe correction that we're having at the moment will look like you won't even see it on a long-term graph. Okay, so that's my strategy. It's not financial advice. It's a disclaimer. So yeah, not financial advice, but it should work over the long term. It's working for me. So like and subscribe, and follow me for for more interesting educational videos. Thank you.